There is a fascinating paradox at the heart of LB Finance's growth story, and honestly, it all boils down to one single number. Yeah, 166.8%. Let that sink in. For every 100 rupees the company gets from you, me, and other customers, they've lent out almost 167. This one number, it's the key to unlocking their whole strategy. Okay, quick heads up. This is purely fundamental analysis for educational purposes. It is not financial advice. So to really get a grip on that massive number, 166.8%, we first have to look at the incredible results it's helping to create. And I mean, the performance is just exceptional. Look at this. Net profit up 24% from last year. Return on equity is hitting almost 22%. That's truly elite territory. Fee income growth is just explosive, and they are super efficient with a cost-to-income ratio of only 31%. Just best-in-class stuff. But honestly, the metric that really makes you stop and stare is the asset quality. Their net non-performing loan ratio, it isn't just low, it's actually negative. So what does that even mean, a negative NPL ratio? Well, it tells you something really crucial about how the management thinks. It means they've set aside more money for potential bad loans than they actually have in bad loans. They're basically over-preparing. They'd rather take a small hit now than get hit by a big surprise later. It's a huge signal of just how conservative they are. Okay, so if the performance is this good and their risk management seems so cautious, then how on earth are they funding all this growth? And how does this connect back to that 166.8% number we started with? Right here. This is the absolute core of their strategy. Check this out. In just 6 months, their loan book exploded by almost 28%. But customer deposits, they only grew by about 10%. So think about it. They're growing their loans nearly 3 times faster than the money coming in from customers. And this chart shows you exactly how they're filling that gap. All those new loans they're issuing, only a small chunk is being paid for by new customer deposits. The rest, that big middle piece, that's coming from wholesale borrowing, basically getting loans from other banks and the debt markets. This is the engine that's pushing that loan-to-deposit ratio all the way up to 166.8%. Now, a high-octane strategy like this always comes with a trade-off. There's always a consequence, and you can see it playing out right on the balance sheet. So the first big consequence is something called capital compression. All that rapid loan growth just eats up capital like it's fuel for a rocket. And you can see it here. Their safety buffers, while still really strong and way above what's required, are definitely shrinking compared to last year. But, and this is a big but, there's a really powerful counterweight to that risk. It's a sign of incredibly high quality, and it's this number, a cash conversion ratio of 1.22. What this means is that their huge profits aren't just some accounting trick. They're not just paper gains. For every single rupee of profit they put on the books, they generated 1 rupee and 22 cents in actual, real cash. That's a sign of just superb earnings quality. And if you look at where the money is actually coming from, it becomes crystal clear what kind of company LB Finance is. At its heart, it's a loans business. I mean, 70% of the profits and almost 73% of their assets are all tied up in loans and advances. Everything else is basically just the supporting cast. So all of this, all these numbers and trade-offs, it really boils the whole analysis down to one single central question about the future of this company. You see, here's the crucial contrast, the paradox we started with. On one side, you've got just incredible operational excellence. We're talking elite returns, perfect-looking asset quality, and amazing cash generation. But on the other side, it's all being paid for by a high-risk, high-reward strategy that relies heavily on outside borrowing. You know, in stable markets where money is cheap and easy to get, this kind of model just prints money. It works beautifully. But in stressed markets, when things get tight, this kind of business is the first to feel the squeeze. That outside funding can get very expensive, or even worse, it can dry up completely. And that right there leaves us with the one big question you have to ask going forward. Can they keep getting the funding they need at a good price to keep this incredible growth engine running? The answer to that question, well, it's going to determine everything.